To have or not to have a single family office. What is a single family office? Our guest today is an expert of 30 years. Let's go. Welcome to Decision Points. I'm Doug Hudson.
I'm Scott Wood.
And she is Missy Lucas from California. Let's go, Missy. How are you?
I'm doing well, thanks, Doug.
Hey, you were just showing off just a second ago. Where do you live and what's the temperature outside right now?
I live in Los Angeles on the west side, and we don't do well if it's under 67 or over 77, and we're right in that sweet spot today.
That is so much more obnoxious flex than I thought you were going to say. I thought you were going to say it's 82, but you just even gave us a 10-degree temperature range.
Our
Pretty
low
much.
temperature's not even going to hit your high
Exactly.
over the next 10 days. Yeah.
Yeah. Well, I pay 13% for this. So
Yes.
there you go.
They call that the weather tax, right? Or is it the sunshine tax or whatever they call that? Yeah.
Something like that.
You are the managing director of family wealth at True North, and
Yeah.
you're one of our newest team members. How long you been with us, Missy?
It's April 1st. No
Yeah.
joke.
Missy,
Yeah.
where are you from? Where were you raised?
I am a born and bred New Yorker. And as anyone who's had conversations with me know, you can take the girl out of New York, but not the New York out of the girl. So,
So what's the New York and the girl? Give us some examples. What's that look like?
interruption is normal conversational style for me.
I love it.
Like, to me, that's just how, it just shows you're engaged, and not just waiting for what you should say when you should say it because it's what you want, like you're actually engaged. I also candidly really don't like to drive. It's very, very, because I'm in New York City. I grew up on subways, from the time I was old enough to be independent. It was subways, buses, and my feet. I walked a lot, which I now know is something you do not do in Dallas, even like 3 weeks.
Well, you can, but we're all just going to smell terrible when we get to the meeting, right?
Oh my goodness, that song "Nobody Walks in LA" should be "Nobody Walks in Dallas."
Yes.
But I really don't like to drive. I'm fine at it, but not. So those are two examples of my
Missy,
New
that's
York.
a phenomenal breakdown. I expected to throw you a little bit of a curveball right there, but I love that. I'm from Fort Lauderdale. You and I have had this conversation, which is New York South.
Yes, it is.
And so there's no such thing as waiting your turn in a conversation. It's a free-for-all.
No, sir. Or I should say, yeah, we just talk. We say what we want to say.
That's right. So, Missy, where in New York?
The Upper East Side, but my family moved from Long Island to East 91st Street when really, it wasn't that long ago, but kind of nobody lived above 86th Street, let alone 90th Street. And it was very middle class. It was 91st Street between Madison and Fifth Avenue. So, absolutely beautiful. But the neighborhood was real middle class. We had delis. We had the first Jackson Hole hamburger chain was downstairs. We had a little Chinese restaurant, dry cleaner. It was really a really lovely, very different from now. It's still lovely, but it's like high-end, all boutiques lovely.
So I lived in New York City for 3 years. And the first year I lived there, I was at 96th and 3rd. And so I would get off the subway at 86th and 3rd and walk up.
Because you took the express, because you couldn't take in the local right there.
Correct. And so I'm very familiar with 91st Street. I know exactly where you lived.
Would you have walked literally by her building?
No, because Madison was, that's the nicer part of the neighborhood. So I didn't get to go that far west.
That was too expensive.
Yes.
You're
Park
over my
Avenue is
budget.
kind of like a dividing line, I guess. I don't know.
Do you remember at what age and your first experience when you rode the subway by yourself?
Gosh, I don't.
You don't?
So my parents grew up somewhere in New York City, product of New York City public schools. And the suburban dream thing was never really took. So we spent a lot of weekends in the city before we moved back. And at some point in there, my parents let my sister and I go on the subway ourselves. But I don't remember.
How old would you have been?
Early to mid-teens,
Yeah.
not so young.
Yeah.
Yeah.
It's incredible. Yeah.
Yeah.
What do you miss about New York?
Walking.
Yeah.
I love to walk everywhere and see the people and see the buildings, see the neighborhoods, see how they've changed. And I do that whenever I'm there. Like I've walked from Chelsea Piers to the Upper East Side, which may not mean anything unless, but I miss walking. I miss the vibrancy of just being surrounded by all different kinds of people. Los Angeles has actually gotten a lot better with that. When I first moved here, it was so striking how balkanized it was. Like, it really felt like I was living in a sea of just white people. And now it's a lot more mixed. And you hear other languages and things like that. But I just love the vibrancy of New York, and I love to walk and just, know what you're going to stumble across.
Yep. I don't know if I shared that with you. I know I've shared it with Scott before. I moved to Dallas when I was 22, and we went and played basketball at this friend of friend's house. They had like a tennis court, basketball court, and I looked around, and I had never seen like 20 dudes who looked identical to me. I was like, oh my gosh, it's a bunch of average 5'10", 5'11" white guys, because South Florida, much like Colombian, South American, every race, religion, and it does bring such a vibrancy to a city. Your world expands. I think Dallas is an amazing city. It's one of the struggles of Dallas. How do we integrate that? And when we get into a whole nother conversation, right? The sociology of it. But I think anyone who's spent any time in New York, it's absolutely a joy to be in. Because it's everywhere you go. Every turn, every street, every building. It's just diverse.
A lot of people find that exhausting, but it gives me energy. I guess different people are different.
So walk us through, you graduate high school from New York. Where do you go to college? I read something here. I've seen it before. Something summa cum laude day. What does that mean?
Yeah, you don't have to worry about that. I was good at school. I love to learn, and I was good at school.
Where'd you go, and why'd you go there?
I went to Princeton, and I went to Princeton. I had always thought I wanted to go to Princeton. And then I found that there was a program at Penn that I really loved. Because I started off as a chemical engineering major, and Penn had a program that was more bioengineering that Princeton didn't have. And also being from New York and being Jewish, although I'm not religious at all, just culturally, it felt more comfortable. It was also a city. I was admitted to Penn as a Benjamin Franklin Scholar, which is really cool. And my dad pretty much said, you got into Princeton.
And you're going to go there.
That's why you're going. Like, in all truth, that's actually, at least that's my memory of it. It was a lot of years ago, but that's my memory of it.
Scott, doesn't that sound very similar to the way you and I chose colleges?
Yeah, exactly. Yeah.
Biochemical engineering. I don't even remember the other one you said. And I went where I got in. So you go through school, and then how do you start to understand career, and what do you want to pursue? What started to attract you to what you're involved with today?
So, my dad only went to college for one semester and had started businesses, and I had actually worked for him from a very young age. Like as soon as I could count, he had a distribution business for small components like diodes and transistors. And from the time I could count, I would make some extra money or earn my allowance. I don't know what it was, but there was money involved. um, by like counting diodes and putting them in little envelopes and labeling them for
So cool.
our clients. So I was always very aware of like work and getting compensated for work. And I didn't really come from an area where you really thought about career. So I knew what I loved to learn and study. And I knew that I wanted to support myself, hopefully well, and make a good living. And that is actually why I chose chemical engineering, because I love chemistry. I still love chemistry. Like I'm such a nerd. I said nerd and dork at the same time.
Nork, I like
thought
that.
it was
Nork. Is that a thing? That's really,
I like that.
You should trademark that right
Nork.
now, by the way.
So I thought chemical engineering was applied chemistry. And about 2 years into studying it, and no offense, you guys, but that's when I learned that the jobs, they were a lot of them and they were well paying at the time, but they were designing distillation columns in Texas. And that was
there was
just
no way you were going to Texas.
Well, and there was no way I was going to be designing distillation columns. Like that just didn't like, that's just like separating out the components of oil for people who don't know, into usable parts of it. So I switched out of engineering to become a biochemistry major just because I loved it. Oh my gosh, that was the hardest call ever to my dad. He was not happy that I was throwing my life away by becoming a biochemistry major. And so I really just studied that because I loved it. And then the only practical thing was to get a job doing science practically and see if I loved that, because you have to go back to graduate school. You have to do all that. So I was very fortunate to get a lab position at Merck in their research labs, and quickly realized that good science is good science, and it's doing the same thing every day. It's spending a lot of time sitting still, which I don't do well. Everyone on the investment team knows that. Like, so by the time I got to Princeton, my world had really opened up, and I just talked to people about, like, what could I do with where I was? And I learned that there were people who were paid quite well to advise or tell other people how they should invest in pharmaceutical companies. And I thought, wow, that's really cool. I can help them with the science. I can go to the conferences. And I was really good at math. And so even though I had only had Econ 101, 102 pass fail, I felt like I could do anything they needed me to do with numbers and modeling. Like I wasn't worried about that. And so that's how I found out about the investment business. It wasn't even remotely in my radar. And it was really about, I'm very focused on like how to, like the work itself, the input of things, and what I do every day, how I spend my time. And I just thought it was fun, and it was cool that people were paid well to do that. So I didn't own a computer. They were new and very expensive. I wrote 300 cold letters on a typewriter that I researched.
Wow.
I talked to everyone I could possibly talk to. Who can I send a letter to? Do you have a name? Do you have an address? And I was fortunate. One of the letters that I wrote was for a non-existent job at the Capital Group companies, because they did not have research assistants at the time. They did have a training program, and they asked me if I'd be interested, and I was fortunate to get the position, and that's.
All right. It's amazing. So walk us through there. So how long do you spend doing that, Missy? And what are you learning? What are you starting to understand your likes and dislikes in kind of the investment world? Yeah. Walk us through that.
I have to admit, at the start, it wasn't really so much about my likes and dislikes. It was just I really wanted to do a great job, so they would hire me.
Mm-hmm.
um, the training program there, very unusual. It's to teach you about the investment business in the capital group way. So the real beauty and why I chose that opportunity is that if they liked you, they hired you at the end of it as if they liked you and your fit was in the investment group, they hired you as though you had an MBA. So that's why I took it
Wow.
because one, I again, I love to learn and I'm good at school. So I just felt like I could learn anything I needed to learn if I worked hard enough. And candidly, the thought my dad paid for college. I worked for spending money and all that, but my dad paid for college. And the thought of being in debt was petrifying. And so business school was petrifying. So I did that. So really, when I was going through the training program, it was really more about just doing the very best job with every assignment that I got. The way that works is you had 6 assignments over 2 years, and you literally work in marketing. You work in accounting. You have one of those sessions that's research. I did REITs. It was actually great. That was my REITs was my assignment. I mean, I love that assignment the best without question, but I really just tried to learn everything I could and just do the best job I could. And actually, I learned accounting. I'm actually really proud of this. So my accounting assignment was to automate by writing what at the time was a very large Lotus 123 macro, which is like a little program. I automated the production of the American funds financial statements. So instead of that all being done by hand, each of the bookkeepers would only have to type in the general ledger, and then this macro would take it and create all. So I really had to learn what was inside accounting. And it was also great training for becoming an analyst because you learn like what each line item means and what like it gives you almost like a visceral sense of what a financial statement is. So I was fortunate that they did make me an offer to stay. I actually graduated from the program 1 session early, so I only did 5. And I started out as a chemical industry analyst in September of 1987, which was a very interesting time to start an investing career.
So, Missy, how many people were in the training program? Like, was it a large cohort or was it just a handful? Or
no, I mean it was. Gosh, It was. I came in also at a little bit of an odd time, I think, because so I started in a January. They did not at the time typically take people out of college. They wanted to take people that had some other experience and was interested in the business. No, it feels like there's a lot because a lot of the leadership of the firm actually came out of the program.
Yeah.
But there were probably like only 4, 5, 6 at a time, something like that is my guess.
Yeah, so it was a small group.
Yeah.
And so you came out of that program and then you were placed in?
I became a chemical industry analyst for the on the institutional business. At the time, the institutional business and the mutual fund business had already separated into different subsidiaries. And then not that long after, the mutual fund company had gotten so big that they split the research effort in 2. And they also needed the healthcare analyst. So I moved over to the mutual fund company supporting the American funds effort, covering both healthcare and chemicals. And that's where I was until I left.
And then how long were you there in total?
Not quite a decade.
Okay. Yeah, so almost 10 years. Yeah.
Almost 10 years.
And then what was the catalyst to jump and start something new?
So honestly, it was just work-life balance. There were no computers. Now we have phones in our pocket. Maybe it makes it easier, maybe not. But that job was 70 hours a week, traveling all the time. I would literally have an assistant FedEx me reading materials at any hotel so that I would be able to not come back to 3 feet of reading to do. That life was not compatible with my family life and being home. And my husband's mother was adopted into the family that founded Carnation Company, and they were interested in having their assets managed better than bank trust departments, meaning better than terrible. Kind of a bar to start.
I knew there was going to be a zinger when you started that line.
So they were very kind to be open-minded and allow me or give me the opportunity, because I don't think I could have ever been just like stay at home. I needed to use my brain and feel productive. So I started off there and started my path from knowing as much as pretty much anybody about a very small segment of the world to becoming what I am now, which is really a generalist. I started on that path. And then, I mean, it's all been accidental is what's interesting. I think most people who are entrepreneurial have that as a drive, and they pursue it. For me, it was much more accidental. And then through a mutual trustee, another family, I wasn't looking for more work. They just were looking for someone to help them more than they had a consultant, and it was kind of a mess. And they were looking for somebody, and they asked this mutual trustee on the team at the time, wonderful man who had worked at Cambridge Associates for a while. He was afterwards was the CIO of the Heinz Foundation, really smart, wonderful person. They asked him who could help them, and he said, well, there's just one person. And that was me. So it was really all accidental.
That's great.
And you've been doing this about how many years now on your own?
A long time, almost 30, not quite 30, 27, 28 years, 20 years.
And how would you, Missy, describe your expertise in your role?
I think my expertise is really helping the families, and if there are multiple entities, by entity, really get to the bottom of what they're trying to achieve and why, and coming to agreement on the how and what the risk taking looks like, and doing everything I possibly can to help them meet the objectives that they want to meet, taking the least possible risk. And when I say risk, I don't mean the numerical volatility that many allocators use. And I don't consider myself an allocator. I consider myself an investor, a client-focused investor. And I think my expertise, or what's different about what I do, is that every single investment process that I've ever done has been specifically to solve an issue I see in one or more client portfolios. I think that's different than others. I don't think this is an expertise. I don't know if that's the right word, but in that ballpark or in that range. I think the other thing about me is that I am very confident in my brain, and that allows me to also feel incredibly comfortable saying, I don't know, I don't understand. Please explain this to me. Like, I'm very comfortable being a beginner and working hard, and asking questions and reading and all of that. So it's enabled me, when I've seen opportunities that I thought might help them achieve their objectives, it's helped me. Some generalists are truly generalists in the sense that they're always covering the waterfront. What I've done instead is really, because I'm only one person, right? When I was on my own, and now since April 1st, it's not only one person. Yep. Thank goodness. I'm so excited about that. But as one person, I would really focus my time and energy on where I thought the opportunities were. And so I've really gotten to be like, it's more like being a serial expert. Like if you talk to fund managers in areas, they would tell you that I know it as well as anyone does. But then there's like wide swaths of the financial market that I just let be, that I don't know anything about. So all of those are, I don't know if it's expertise, but differentiators.
Yeah. Let's go back to something you said a second ago, Missy, because I think it's really important. And, for those listening, you said, I don't consider myself an allocator. I consider myself an investor. Can you just differentiate for those who might not know the difference or understand the difference, what that means to you?
Yeah, I was going to start with it's what it means to me, because I think the words are used fairly interchangeably in the vernacular today. What that means to me is that I really look at the portfolios as a whole, and each line item of them as investments, and as investments in pursuit of specific goals. How does all that work? It's very bottom up, maybe a ways to say it is. And I don't mean by that I ignore interest rates or money flows, or I do care about those, but my mindset is very much from the bottom up as an investor. And being an allocator to me is deciding that I'm going to have a diversified portfolio. A lot of times that happens because it's a big endowment or a very big family office, and they have a team, and they have a credit person, and they have a public equity person, and maybe they have like 6 different people under them doing different things, and they have a venture person, and they just decide on metrics that are more easily reportable to the CIO or the board, which may be, we want our portfolio to look like this. We want to have this amount in buyouts. We want to have this amount in domestic large cap equities. And then they fill those targets, because that's a really clear metric to show that you have some control over, by the way.
Right.
That you can show to your CIO and then to your board and say, we're doing what we told you we would do. Like, to me, an allocator is more about setting a model and doing what you say you're going to do to fill it. And I am, as an investor, deeply focused on helping my clients achieve their specific goals with reasonable risk, with risk that they can tolerate.
So yeah, absolutely. The only thing I want you to explain again for our listeners is the difference between top down and bottom up, just in case some people don't know that term. And then after you do that, give us an example of an opportunity that is sort of investment focused, where you said, this is a really great opportunity. This needs to be in the portfolio. It's kind of an example of a bottom up, opportunity that you found. And then, what percentage of the portfolio did it end up taking? And the reason that is important is because if you're not an allocator, you don't start that way. You could find an opportunity that you might let be 10, 15, 20, 25% of the portfolio if you felt really a lot of conviction around that opportunity. Did I give you too much?
Well, so sometimes that just happens because things go up and you don't necessarily control the exit. So
you made a good decision and it got bigger.
Yeah, it's well said. Yeah.
So, so bottom up means you're looking at the details first. The best way to think about it, maybe an analogy, is if you're looking at a forest or like a forested area, top down would be you would take in the whole picture, and then you'd see how big it is, and then you'd work your way back to what kinds of trees there were and how far there's spaced, and are there different like groupings of trees in different areas of the forest and things like that. And the bottom up is really just looking at the details first, and then kind of allowing the forest to end up looking like whatever it looks like.
Makes sense.
Almost. Almost. I mean, I don't want it to sound like we don't have asset allocation bands and that we look at them every quarter. Of course we do. But it's not what drives the decision.
Right. That's right.
So So an example on the negative side of what you said, as opposed to the positive, is for a very long time, to my mind, fixed income, high grade, like all across the spectrum was, I love the term return free risk because I think it was. So even though my clients' portfolios, the largest ones actually do have to pay out distributions all the time.
Mm-hmm.
And they cannot structurally have assets added to them. So it's a hard goal. I still didn't want fixed income. And my first rule is you really don't want to permanently lose capital. So it's not that I'm a swinging for the fences person for that. But we really had zero. We still actually have zero high grade, longer term fixed income. Now we have some cash. But so I would say that is an example because my clients, to meet their goals, their specific goals, I'm not saying this is right or wrong. This is just my client set currently and what they try to do. It's between like 7.5% and 8.5% or 7-8% of long-term absolute returns to meet their goals. And you couldn't hold that. So that's an example of the negative.
An allocation to fixed income wasn't going to get you there, right?
No, yeah.
Right?
So it was zero.
Whereas
Yeah.
a traditional allocator, not to interrupt, but we are talking New York
please.
here.
We established those ground rules early.
That's right. But a traditional allocator would say, from the start, top down, we've got to have 35% in fixed income to make the pie chart look balanced. And what you're saying is, no, to get to 7.5-8% total return, there's no way we can have fixed income as any kind of significant allocation in the portfolio. It just won't work given where the macro environment was.
Exactly. And that just shows how in the weeds I really am because I couldn't articulate that the way you did. So thank you. Exactly. The starkest example of something getting big out of control was the distressed debt cycle of the early 2000s. Leaned into that pretty hard at that time. And for a long time, you could actually make really nice returns, not entrepreneurial venture capital returns, but really nice returns by having cash and being willing to not touch it, like having the liquidity be out of your control when other people needed money. So leaned heavily into that and as into distressed debt funds. And there was a point at which those funds were about a third of the portfolio on a mark-to-market basis, not because that was the decision, but because equity markets went down a lot and these did quite well.
Mm-hmm.
That corrected as the manager sold the assets. And also, if you looked underneath it, even though they were distressed debt funds, a lot of the holdings became equity, and that's why it worked. I would not recommend that. That was not a comfortable thing having that much. But again, an allocator, and we see this periodically. We saw this in venture recently. An allocator will say that's too high and will do things like look to sell those positions in the secondary market and be willing to take a discount on them because they need to hit their target allocation.
Mm-hmm.
Whereas my mindset is that this is a good thing.
Yeah.
This is working out and we're on a path to liquidity. And is this number comfortable? No, but it's also kind of meaningless and it will correct itself over time. So that's also a mindset.
Yeah. Well said. Yeah. All right. So Doug and I have a question for you. Go ahead. We talked about this ahead of time. This is the big question.
We did. As your role as managing director of family wealth, you're serving ultra high net worth families, and you've been doing that for a while. So I didn't graduate summa cum laude from anywhere, much less Princeton. But to quote Shakespeare, to have or not to have a family office. Family made a bunch of money. It seems like sometimes families get conflicted or don't have good guiding principles or consultation on when, if, why, how to start a family office.
And the context I would add to the question is, let's just go back 20 years ago, 25. There weren't a lot of family offices. I mean, there were some, and they were around and whatever, but typically very large families. Now, in some ways it seems like everybody's got a family office, or it's the cool thing to do. I have $100 million, and so I need to go start a family office because that's what I'm supposed to do. That's what all my friends are doing. So help us and help the audience understand when it makes sense to have a family office, when it makes sense to not have a family office, and what some of the decisions might be to get to the right place or the right answer.
I'll do my best. Please interrupt and ask me questions.
Absolutely.
We will. You know it.
Yeah. So I think it depends. The first thing that anyone should think about is, what are you trying to do with your family office? Because, there's a saying, I get a lot of questions from investors, like general partners of funds, like, how do I crack the family office market? And there's a saying, if you've met one family office, you've met one family office.
Mm-hmm.
It really is a very individual thing. So if let's say your money's from real estate that you still own, that's cash producing, and you really want more an administrative family office, you want somebody to take care of insurance and accounting and dog walking and airplane rental. I think that, for $100 million, you could get a really good CFO. I think you can get like a CFO, bookkeeper. You can do things like that. And you can do a really good job. And if you want to invest, if you're looking to invest some money, but you don't actually, like, at a certain point, maybe you don't need to do really well with that, to be honest. And it's your money. You've worked hard. You've earned it. Maybe it's just fun for you to do deals that come to you and that you hear about, and that's all the investing that you want to do. And I don't think there's anything wrong with that. And I certainly think if you have, I don't know, I'm going to pull a number out of my head, but like $500 million or more, I think it does take that much. I don't think it's $100 million. I'm sure it's not $100 million because I would not have had the opportunity I had if it were $100 million. But if you're at like $500 million or $1 billion, I think at that point, and you care about investing and actually covering the landscape reasonably well, having good access, not being stuck with adverse selection, I think that's the point. I feel that where what I do is helpful is in the middle there.
Mm-hmm.
I don't know, pick a number. It's under 100 million. I don't know where under 100 million, but certainly under 100 million to certainly $250 million. I feel like, and candidly, and I'm not saying this, it was a really big deal for me to come to True North. I think being at True North is even better, but in that whole range, even to have one person, you can't afford them. You can't.
Right.
Yeah. So I think a family really thinking about, is this family office supposed to serve the purpose of extending this wealth to the next generation, educating that next generation about money and investing and the future and risks and rewards, and having an infrastructure in place for them when you're not there, then I think not doing it yourself is a far better choice. That's my opinion.
That's great. So I think, thank you for that.
Yeah.
I think that's one of the things that people struggle with, right? Because again, their peers or relationships around them would say, okay, I need to go start a family office, but it's not always the right scenario. And I do appreciate you articulating, if you've seen one family office, you've seen one family office, because indeed they are all different and they all have different needs. And that's because families are all different and they have different needs.
What are one of the things I loved about your answer, Missy, I was going to ask you for like I was going to ask you for like markers and milestones, and I expect you to say, Doug, I won't give that to you. And you came straight out and said, no, it's somewhere between 500 million and $1 billion. I love that. So I'm not surprised by your answer, but I am grateful that because of your expertise, because you've done this so long, you basically, not basically, you do know the economics. Inherently, as listeners are listening to this, Missy, $100 million seems like a lot of money. And so-and-so and so-and-so started their own single-family offices. What are inherently some of the problems that they're getting into that they're not aware of? Share some of that good, bad, and ugly before you go do this. These are the questions you've asked your why, but you know where I'm going. What are some of these questions, hard questions, you would ask them at a lunch right now if they said, Missy, I got $110 million. I want to start a family office. Go.
Why?
Well, the Woods do it, and it seems really cool. And that's a lot of. Go ahead.
It is really cool. It is cool, and there are all kinds of events you could go to. There are some really fun family office events in Florida, and it is cool. A lot of conferences. There's family office exchange. It is cool. And honestly, if that's what's important to you, and that is the most, like, for me, everything I do starts with listening and asking questions. So I didn't mean to just turn it around to you when I said why. It really is. I would really try to help them figure out what they're doing and whether that's the best way to accomplish that. Because first of all, to do it right is a lot of hard work. Like, whoever's running that is not going to really ever get away from it. There's no such thing as a real vacation. And that's okay if you love it and if it's what you want to do, but understand that you've also worked hard in this scenario, and you may not want that anymore, right? You have an idea of it kind of as a retirement gig. And to do it right, it's not. And one of the things that you see, and in particularly smaller family offices, but even some larger ones, is tremendous turnover of people. So even if you decide, okay, I'm going to invest in someone to really run the family office for me and do all that quote unquote stuff, that job tends to be really unfulfilling and high pressure. And there's a lot of turnover, and that's a lot of stress for you. So I would have conversations around that. And if it's the cool factor, what part of it is cool for you? Because I think for a lot of people, what's cool is the having fun investments to talk about with your friends. And I understand that because I get to do that every day, and it is a lot of fun. It is mostly fun though when it on average works. When things are bad, it really hurts. So I would talk about the immense adverse selection that happens in the family office space. I promise you that they're not the first, second, or third call. I know those people. I've been in the business for we already established for decades. They're not the first, second, or third call. So to really know what's good and what's not, like if you care about the investments, then I would say just be really, really, really careful. And I would say if it's cool investments, you can work with me. You can work with a firm like True North and have the benefit of, I'm not really much of a marketer, I must say, but I really deeply believe this. You can have the benefit of a team that's really steeped in the details and the weeds and doing some really cool stuff that's in your portfolio that you can talk to your friends about, but hopefully also is going to make you money.
Well, I think I feel like within the family office world, and this is more locally here, just there is this sense of, oh, here's a deal, and then the deal gets passed around to every family, and it's a little bit of a, I don't want to call it a popularity thing, but it's a little bit of, oh, well, so-and-so's underwriting this, so it must be good. And there's not a lot of real diligence going on. It's kind of like, oh, so-and-so who's been successful in the past maybe and has a good, track record is underwriting this, maybe they made their money in oil and gas, but this is a multifamily deal, and it's something totally different, and it just sort of makes its way around here in Dallas, where a lot of family offices office. Just it's sort of like this pass the hat, but a lot of times I don't feel like the real diligence is being done and the real deep research to really look at these opportunities.
I don't think that's just Texas. I think I've seen that like the northern suburbs of Chicago, there's a similar group. There's in Florida, in the Miami area. Yeah, I think that's human nature. And again, there's nothing wrong with that
Right.
at all if the joy for you as an individual comes from being part of that community and doing those deals and not and whatever the outcome is financially, like, more power to you. You earned that right.
Yeah.
And that's okay. But be realistic about what you just said. You don't know what else is going on in multifamily office. You don't know. You're not doing that deep work. And so it might work, but the odds are more against you, particularly because family offices tend to do deal by deal things. And that's the hardest to do. When I said that I'm an investor and I look at portfolios, I'm always looking at where there are holes in the portfolio and where maybe if you look underneath all the different line items, there may be more exposure than we might want. I'm always looking at it from that perspective. And if you're operating on the who's doing the next deal and I'm going to be part of that, it's unlikely that you're going to have that portfolio construction that is going to be a little bit more all weather, have multiple shots on goal. People tend to get a vein of opportunities. So they'll do one multifamily deal. And then, to be honest, you kind of have a target on your back for more multifamily deals. And so you end up with a lot of multifamily deals. And maybe that's great if it happens to be great market or markets and multifamily is the right area. But you've got that one shot on goal for that whole vintage. And I just think you're taking on way more risk than you think you are.
Well, and I also think the thing that's challenging about this is, let's say you do have a family office, and let's say it's $100 million or whatever, and you've got an analyst or an investment person working for you in the office so that they can do some of that stuff that you talked about. The challenge is that individual probably has an expertise in maybe a couple of areas, but they're not going to know the whole landscape, the whole investment waterfront, right? And so they may be really good at multifamily, but they may not know anything about oil and gas, and so or whatever. And so I think you also get into this trap of how are you going to allocate capital, make investments if you don't really have if you don't have the expertise.
And I think at times there's a little bit. I mean, Missy, you course correct me, but you start to have a 5-person team. Is there a conflict of interest for them to give their true opinions? You're paying them, but so they don't really want to rock the boat because you're paying their salary, but you think this investment is kind of a terrible deal. You're really testing someone's integrity to give you that honest feedback on par or not.
Oh, it's why. So first of all, at $100 million, there's no economically sensible way for you to even have one really good investment person, unless they're doing it for love, which I did, in some part. You just can't. And Doug, to your point, it's even at the most prestigious, because there are a couple of them here in LA, like celebrities. They're good people. They've done really well. They pay really well. Even at that level, the turnover at the CIO, at the Chief Investment Officer seat, is super high for this reason. Either they do speak up, and ultimately it's the person's money, right? They get to do what they want to do, or they just get frustrated because ultimately that is the construct. And also, I mean, I hate to, I don't want to diminish. $100 million is a lot of money. I mean, no, but $100 million, if you have a multi-generational legacy and that you're thinking about, and if maybe you have 2, 3, 4 children, and they have 2, 3, 4 children, and then you separate that out, and plus you're living some of your life, it's really not, if you have that desire, which you don't have to have, it's fine if you don't. But if you have that desire, it's remarkable how supporting one couple or one nuclear family, and then supporting 3, and then supporting more, it's a much harder situation. So I think especially if you have an interest in the financial part, whether it's in a foundation or it's trusts or whatever, if you want that money to last, and there's a saying about short sleeves to short sleeves in 3 generations, I think it is, that comes from experience. I think, I hate to say it because I don't mean it in any negative way. It's just not as much money as you think when you think about that context.
Right. Yep. Good point.
I want to start to kind of wrap our time up, Missy, and thank you for your time. I'd love for you to, as the managing director of Family Wealth, what's your vision for us, for True North, for our clients? What's your vision? What's your wish list? What's a success look like for our clients with your leadership there?
Well, success for clients is feeling really good that you've defined your goals over the long term, and that, hopefully ultimately we're meeting them. And that even if in a particular quarter things don't go our way, you understand and you know why we're on this path and why we hold what we hold, and that you have confidence that you feel that we are on the path. I mean, that on a micro level, I feel so. I'd like to just step back and say that I know that I'm mortal, and I know that I'm only one person. And I started a search when I became an empty nester in the spring of 2018 for a partner for my firm. And I had so many conversations and even some opportunities. And I candidly really believe that most people in this business, in our business, are much more focused on their own profitability and bottom line and how they can make money and where the leverage in their businesses, and remarkably little in the end about how the clients do. The saying, where are the clients' yachts? That's more for hedge fund managers and more apropos for hedge fund managers, but I feel like it's also in some part true in our business. There's just not a caring about it. You have to, the business has to be healthy. The business has to be profitable. It has to be able to grow, has to be able to support people. But what I really so deeply hope, and I feel so values aligned with True North, which is why I'm here, is that we can do that in the context of really serving clients, really listening to clients, really serving clients, really caring about how clients do. And my hope is that it's not, in all honesty, that is not just family wealth, that it just adds to, the effort already exists, right? I did not invent, by any means, don't want to take, this existed already. I'm talking about why I joined and what I want to further develop. One thing we didn't talk about, and I should have, in scale, is that because you do need a certain scale to both access and to properly diversify the more sophisticated investments. And in that sense, $100 million also isn't a ton. Let alone if you've worked really hard and you have $20 million. Like these are the people from 20 million to pick a number, but over 100 million, I feel are the most poorly served by our business. These are people who I think deserve the very best ideas, the very best thinking, the very best support on their journeys, whatever those are. And it's really terrible out there. And I really hope to change that. So I hope that we're successful in doing that for more clients and really showing them what it's like to be treated well and to be cared about and to be delivered for. So
I love that.
On decision points, Missy, and this is candidly not a True North advertisement commercial. This is about conversations to help business owners, families, understand wealth, make wise decisions. But your answer, your response, it just shows your care factor. And I couldn't agree more. Scott and Mark built True North on doing the very best to listen as closely and giving wise counsel and objective counsel. And that's clearly what you've done for your families. And we're super grateful you're going to continue to do that with True North. So, Missy, won't be our last conversation on decision points. Thanks for your time and energy to serve our listeners today.
Thanks, Missy.
Thanks for having me.
Go take a walk in that beautiful weather.
I'm going to.